In this week's update, mainstream narrative has been wrong all year. What has worked and why? And will the momentum continue? My name's Garry Davis, and as always, this is general advice only. And please remember to like and subscribe to the video. All right, let's just start with a bit of market perspective. We're getting close to the end of the year. There'll be one more edition next week, and that will probably be it for the year, I would suspect. I just want to look at where the opportunities are, both in America and in Australia, just in general terms. There is the sector rotation in America, which started with the first announcement about the vaccine. That continues, and I guess that was always going to be the case to a degree. And the rotation is actually healthy. And if you think back to the naysayers that have been pointing to the fact that the FANG stocks have done so incredibly well for many years and said that they were the only reason that the indexes were going up. Well, now those same people are saying, well, we've now got a rotation and that's not healthy for the market either. Well, you can't have it both ways. So whichever way you look at it, this continued advance in pretty much all sectors now, and particularly small caps, and I'll come back to that, is very, very healthy, and it certainly bodes well for markets in 2021. Now, I made this point last week, and I'll just touch on it briefly again because I think it is important. It won't necessarily suit everybody, but I think it's an important point to remember. Yes, we can make money out of rebounds in the out-of-favour stocks, the stocks that were so badly beaten up by the restrictions from COVID-19. But you've got to remember that there's two sides to the equation. It's not just about how much money you can make. It's about the likelihood that profit will emerge. And secondly, the downside risks should things not work out. So always remember the probability and the risks that go with those out-of-favour rebounds. And many of those sectors have got long-term structural headwinds. This is not just a rebound from being beaten up. They're going to find life far more difficult in the future than they have in the past. Whereas let's look at the areas that are doing incredibly well and are almost certain to continue to do extraordinarily well. The life sciences in America, the science around that in all sorts of areas is just incredible. And I just learned something new and exciting almost every day. Digital technology is an absolute juggernaut with artificial intelligence, 5G, the use of cloud computing, etc., etc. So those sectors are going to continue to advance no matter what. So the answer is not to avoid the market. The answer is to find the best ways to play these particular themes that have got an incredibly high probability of advancing substantially in future years. That's the answer. Now, if we look at the local market opportunities in Australia, there are numerous small caps that are performing just outrageously well. They are quite high volatility, and so they're not necessarily suitable for all investors because moves of 10, 20, 30% and sometimes even more in a single day have become not uncommon. And a lot of people just can't deal with that level of volatility. So you need to make sure that what you're chasing is suitable for your objectives. But there certainly are many of them, that's for sure. Now in Australia, we are seeing sector rebounds underway in energy, in finance, in infrastructure. But we always come back to this point again. You've got to look at the probability of it being achieved and sustained, and the risks that something goes wrong. What if COVID restrictions are reimposed? What if the logistics around vaccination don't work out as quickly or as people would expect? I'm not suggesting that they won't, but there is a risk there. Whereas if you look at something like the 5G network that's going to be built, fibre network that's going to be built around the world, to me there is absolutely no uncertainty about that at all. It's going to happen. And so therefore you find the beneficiaries of that mega trend. So in the local market, we don't have as many opportunities as we do in the US market, but stay with the stocks that are heavily linked to the mega trends, and that way at least you know that you've got a tailwind that can that can sustain the prices in the medium term. All right, turning to American stocks now. The S&P it didn't do a lot last week. It went up a bit, went down a little bit, and ended up down 1% for the week. But every major index is making new highs. The Nasdaq, the S&P, the Dow, the Russell, they're all making new highs. Just be aware that in the next week there is some short-term seasonality, and we're only talking about the next week or so. There certainly is some seasonality that is against the market continuing to advance. And also there is the markets are at a pretty reasonable level of overboughtness. I'm not sure if that's a correct word or not, but I'll use it because it's appropriate. Markets are overbought in the short term. So don't be surprised to see a bit of a wobble in the next week, and then perhaps a return to the end of year Christmas rally. And I find it hard to see what might stand in the way of a Christmas rally eventually unfolding. It might only be the last few days of the year, but I still think we're going to get one. But the key thing here is stock selection. There are many stocks that are being punished for particular announcements or particular reasons. So it's not just one tide is lifting all boats. There certainly is still the requirement for you to do your homework and be very selective about the companies that you're buying. Now the US dollar was up slightly. It was about 0.1 or 0.2 of a cent, but essentially it's just forming a little base at the moment. And the 10-year yield is holding firm around this 0.9% mark. So let's take a look at some charts. We'll start with the S&P. And as I said last week, the current overall setup in the US market is that all indices are doing well, and especially the very broadly based small caps. And that's incredibly bullish for the market. The fact that all indices are doing well, but small caps, more so than any. And we'll look at a pretty insightful chart at the moment that I think says it all. So the whole mix of what all the indices are doing really renders this rally more sustainable. And so therefore I can only be bullish, continue to be bullish for 2021. Yes, there'll be volatility. I can absolutely promise you there will be volatility, and we will probably get some fairly sudden moves. But overall, I think the indices head higher because there's every reason for them, and that's where the trends are at the moment. It's pretty hard to argue with this trend. The S&P is just continuing to hold above the 20-day moving average, which is the green line, and of course the 50-day as well, which is the blue line. So just staying with what is, the trend is up. There's no reason why that is not going to continue. All right, let's look at a couple of these ratios that are important. So we'll just get to this. Right, okay. So this is the Russell 2000 divided into the S&P index. Right over on the left-hand side here, we go all the way back to 2002, 2003, which is when we had the tech wreck and the market was in a downtrend for nearly 18 months. That finished at towards the end of 2002. So obviously the line rising means that that small caps are outperforming the broader market, the S&P 500. So coming out of that crash, I mean, that's logical because during corrections and crashes, small cap stocks get absolutely belted. So they go down far more than the general market. So it's only reasonable and logical to expect that we're getting a rebound. The question is, to what extent? How sharp is the rebound? How bullish is that move into small caps, which sustains the market? So you can see coming out of the tech wreck crash, we had a long period of outperformance of small caps that started in 2003 and it ran all the way to 2006. So it ran for 3 years where small caps did far better than the general market. Now, there's been all sorts of other instances along the way. We had, obviously, this is coming out of the GFC, so that peaked. Coming out of the GFC, the GFC is finishing here. So we had a sustained period of outperformance of small caps. Pretty volatile, but nevertheless, the trend was up. And again, every time we had a correction where small caps got belted, we had a sustained recovery. Here again in 2016, where the market went down for a couple of months at the start of 2016. We then got a pretty decent period of outperformance. And now look what's just happened coming out of the March crash. We've had a significant period where small caps have recovered very well. And just look at the steepness of the last few weeks. It has really exploded to the upside. Now, this has already come back a fair way, and we can't know for sure how long this continues because, as we saw over here, some of these outperformance periods lasted 3 years. Some of them only lasted 6 months or 6 to 12 months. So we don't know how long this will continue, but what we can say at the moment on what we see is that the ratio is highly supportive of the market continuing its overall move to the upside. I think that's a reasonable conclusion. Stay with what is until it ceases to be the case is the best way to go about engaging with the market. Let's just look at a couple of the other ratios that we've been looking at now for quite some months. This is the Russell 1000 growth stocks divided by value stocks. So growth outperformed value for a long period of time. We then got some rotation back into value. But again, this ratio is stalled because they're both going up together. So we got a bit of short-term rotation into value stocks, but it hasn't really continued. Money has continued to support the aggressive sectors, technology, consumer discretionary, healthcare. So, that's really supportive of the overall market. This is consumer discretionary versus consumer staples. So same situation, money flowing readily into all sectors. And this is industrials versus the S&P. So this line is still intact and rising. So we've got a lot of positives there. Going now to the US dollar. So clearly in substantial downtrend, but just in the last week, nothing much changed, pretty much went sideways. Now there's lots of people trying to argue that the US dollar is going to reverse and go back up again, but I'm guided by the charts, and at the moment there is nothing in the charts to suggest that is about to happen. Now maybe it will, but I'll wait until the charts show me. So at the moment the US dollar is in quite significant downtrend. That, of course, is putting upward pressure on the Australian dollar, but the Australian dollar is getting an extra kick at the moment because of iron ore prices and because of the global reflation trade. The expectation that commodities are going to do well in coming years, and that's always supportive of the Australian dollar. So we're certainly seeing some real strength there in the Aussie dollar. So we're back up, finished at 75.1. Now the index was higher by just a few points, 0.1%. And as I outlined last week, a large part of the trade in top 100 stocks has been from overseas players that are really got an eye on currency movements as well. That always makes me a bit nervous because you don't know when that is going to reverse. Maybe it will, maybe it won't, but I just don't like the uncertainty. I like to know that the trends that I'm on are overwhelmingly sustainable. So for me, small cap growth stocks in Australia is where the action is. If they're tied into the mega trends, then all the better. So let's just take a quick look at the Australian index. So you can see we've now broken out of this long period of sideways movement that we had with the index, and we are trending higher. Let's look at some of the individual components. So this is sorry, that's XLK, that's incorrect. Right, this is the one I wanted. This is the materials index, so this reflects all the large mining stocks. and we've broken out. It's basically now at highs that go all the way back to 2011. We're probably not at all-time highs, which occurred in 2008, but we're certainly heading in that direction fairly quickly. So that is certainly supportive of the Australian dollar. If we look at the healthcare sector, it's really been broadly going sideways now for quite some time, since the start of the year. Although there is quite a variation in performance within that index. This is the banks, so finance is definitely back into the uptrend, but it's just not one that I can support because of the the long-term structural headwinds that the industry faces. And I see the same thing in the energy sector as well. So yes, it's going up, but for how much longer? Whereas I can feel really, really super confident about where digital technology and life sciences are going, particularly in America over the longer term. All right, turning now to precious metals. Gold almost unchanged, gained $1 to 18.40. And I think the key thing with gold is that, irrespective of what the price might do in the short term, there are multiple tailwinds that support prices. And I touch on this every now and again, and I'll just do a bit of a reminder this week on the next slide. But there really are a number of tailwinds, and it's not just a currency trade either. Now, the other key point is that I think sufficient correction has now been done. I touched on this last week. So I think the market or the sector is now in a position where it can move higher. The long positioning in the speculative futures market for gold is 25% lower than July. I would have liked to have seen a bit more, to be honest. That would de-risk it even further. But look, a 25% pullback in long positioning in the futures market is pretty significant. So it's certainly enough to clean out the cupboard. Precious metal stocks, I think we're in the process of a sector reversal, but you've got to recognise that it's not a 1 or 2 day event or a weekly event. It's a process, and it might take several weeks or even a couple of months. Sometimes once the lows have been formed, the stock prices don't readily start moving. But I think looking at the balance of probabilities and looking at the charts, I think it's reasonable now to start to rebuild exposure steadily. I wouldn't go after it enthusiastically, but I think if you can buy good quality gold stocks, particularly in America, where obviously we don't have the currency drag that we're seeing in the Australian for the Australian stocks. The Australian dollar gold price has fallen. Earlier in the year, it was around 27.50. Now it's down around 2400. So that has certainly been holding our local stocks down. But really, these are shorter term influences. I think the Australian gold stocks are still going to do fairly well. So if we look at gold, there it is on a weekly chart. So we came back down to the bottom of the trend channel, and we've had a nice bounce so far. We may continue just to bounce around here for a little bit, but I think this is a relatively low risk point to be starting to build. And at the end of the day, in markets, we don't have any certainties. All we have is probabilities, and the better we can play the probabilities, then generally the better result that we get. And that's looking at gold on a daily chart. So you can see we've tagged the 200-day moving average. So that's another it's another piece of the puzzle that normally happens. Gold normally retraces to the 200-day moving average or below to complete a correction. That has now happened. Silver is going sideways and therefore and staying well above the 200-day moving average. So we've certainly had a bit of relative outperformance there, which is, again, that's positive. There is quite a good correlation between when silver does well, the overall precious metals sector does well. And if we look at the mining stocks, we're going to see in the fourth quarter an absolute explosion in profits. That is not being reflected in the share prices. I think that's yet to happen. And also on GDX, we've come down and we've tagged the 200-day moving average. So that fulfills that requirement as well. It doesn't guarantee anything. It just adds weight to what we're doing. Turning to other, on gold. So gold benefits from a number of different factors. There's quite a lot of complex relationships here. So I know that a lot of people think that it's just a simple inverse relationship with the US dollar and that's all there is to it. That is far from the case. Gold does well when there are negative real interest rates because there's no penalty in owning gold, and we certainly have negative real interest rates, and it's very difficult to see how that's going to change. Fear of inflation is good for gold, and we're starting to see a little bit of global reflation at the moment. How far that goes and how far central banks allow it to happen is another question. But trade deficits and the US budget is certainly supportive. The fear of the loss of purchasing power, obviously, all currencies are being debased as more and more money gets printed. The alternative to bond yields, all asset classes attract money or see money flow out according to their relative attractiveness. And the 10-year yield at the moment, you can give your money to the US government for 10 years and get less than 1% per annum. I don't think that's a very good deal, particularly when you stand a chance of having capital loss as well, because bonds are being sold. And then finally, the direction of the US dollar, yes, has some impact, but it's only one little bit of the overall influence. Okay, and also too, the correlation between the US dollar direction and the direction of gold, again, is just not as strong as many people think when you actually look at the charts of that correlation. Now, turning to other commodities, copper was steady at $3.50. There's a terrific long-term story, 5 to 10 years unfolding here. We may not have yet reached the real momentum inflection point, but it's certainly coming. Crude oil was slightly firmer again to 46.5, but I think this is not looking very sustainable from my point of view, because the crude price does hinge a fair bit off how much inventory is in the system. And in the last week, we just saw the biggest rise in inventories, or the third biggest rise in inventories this year, of 15 million barrels. That's huge. So, don't expect crude oil to keep going up from here. There's the spot copper chart. Not a lot of change there. So just to wrap it all up, the mainstream narrative has been wrong for a lot of years, but it's been exceptionally wrong this year. Just, think back to when COVID started and the restrictions came in, all the predictions that people were making that, the market would crash and it would take years to come back and all that sort of stuff. Well, it's been spectacularly wrong. And there is absolutely no substitute for staying with what is. You observe the market action and you respond to the market action using the balance of probabilities. And there's just no substitute for doing that. We make money at the end of the day because prices go up. It's no more complex than that. We don't make money because we get the fundamentals, all the fundamental boxes ticked. I've seen stocks that all the fundamentals look fantastic, the valuations, everything. The share price keeps going down. So you got to remember, at the end of the day, that's how we make our money. We make our money because prices are rising. So you need to use that edge to your advantage. Now, many fundamental methods are not working because they're not capturing the value of what is increasingly dominating markets these days, and they're high-tech businesses. Whether it's in digital technology, whether it's in life sciences technology, whether it's in payments technology, wherever it might be, increasingly high-tech businesses are dominating the markets. And fundamental methods of analysis just do not capture the sort of value that exists in this business. So what we typically hear is that the PE ratios are too high. That's ridiculous. I'm not paying 50 times earnings. Or we hear that the book value multiple is far too high. These are all traditional ways of valuing a company that were relevant 10, 20, 30 years ago. but they are less relevant. They're not irrelevant, but they are less relevant by a long way now than they used to be. There are other things that you need to consider. So I'm not saying that we should abandon these ratios, but you just need to bring into account other things. The other lament we've heard, of course, is that companies won't make a profit for years and years. I mean, that's what we're hearing constantly about stocks like Afterpay Touch. They're not going to make a profit for years. Well, guess what? Neither did Amazon, neither did Google or Facebook. Yet look at the businesses that they have matured into. They're some of the best businesses on the planet. So just because a company won't make a profit for a few years is not a black mark. So what hidden value is there in let me call them new age companies that is real? One of the key things, and this isn't something new, but I guess it's probably got more emphasis now than it used to, is that when consumers absolutely love a product or a service, it drives massive growth. Now, I remember reading a book by Peter Lynch, who's one of the legendary fund managers of all time, and this is probably going back 40 years. And this was a theme that he built his extraordinary performance around back in the 60s and 70s and 80s, was that you identify products and services that people absolutely love and fall over themselves to buy. And you just do that, and the company grows massively and the share price goes up, and that's really all you need to know. So this is not a new concept by any stretch of the imagination, but it doesn't appear on the profit and loss statement. It has value. It doesn't appear on the balance sheet. It's not there as an asset, but it has incredible value. In fact, I'd suggest that it is perhaps the most valuable asset that a company could have. Profit reinvestment into scale and growth. Now, in past decades, companies didn't reinvest such a high proportion of their potential profit into growing the business, because you just couldn't grow businesses that quickly on a global scale that we now can do in this digital age, in the internet age. So companies didn't do it, couldn't do it, but now they can. And so there is a massive land grab in all sorts of different areas to gain market share. And so potential profits are being turned back into growing that scale as fast as possible and seeking to dominate the market. Again, that doesn't appear on the P&L or the balance sheet. Now, most of the new age companies don't have a heavy capital base. They don't have a lot of bricks and mortar, machinery. They don't have things that require a lot of fixed investment. And as a consequence, they can generate extremely high return on equities. And at the end of the day, that's one of the biggest drivers of the share price. But and so that makes the book value equation look awful, because they don't have much in the way of book value, and all they've got is a high share price with a very small capital base and book value. But that's actually a good thing in my view. It's not a bad thing, it's a good thing. So I don't worry at all about high ratios, high book to value multiples. Another thing is that the network effects that are enabled now by the digital world that we live in are real. They can be exploited. You couldn't do that 20 or 30 years ago because it just didn't really exist. But now it does, and it doesn't appear on the P&L or the balance sheet, and so therefore doesn't come into the traditional methodologies for valuing a company. Now, there are stocks that are grossly overvalued. There's no question about that, and they're going to come back significantly in price. So it's not a matter of just throwing the rule book out the window, the valuation rule book, and saying, well, if that's the case, I'll just buy anything and it'll all be fine. That will not be the case at all. Stocks will get overvalued. They will come back substantially, and that could be 25 to 50% or even more in relatively short periods of time. So there's still plenty of potential dangers out there. But just because there's some grossly overvalued stocks doesn't mean you have to avoid the market altogether. You know, there's some stocks that are just have got unbelievably good futures ahead of them. So we just participate in those ones. So we come back to the selectivity issue. So if you listen to mainstream forecasts, I can almost promise you are going to be misled, because they're just not focused on the things that are relevant these days. So that's it for this week. Portfolio Analyst next week. I've got a couple of things that I'm going to do for members that I think is just adding spice to the portfolios and the opportunities that we've got. And I just continue to be extraordinarily excited and bullish about what's unfolding for 2021. That's it for this week. Cheers.